Let's talk about the optimal way to structure your wealth in retirement. So the first scenario one, is what I would consider an optimal structure for the use of wealth. So the client has a $2 million primary residence. They've got $3.8 million in their pension accounts. So it's a couple. So they've each got $1.9 million in their tax-free pension account, which is the maximum that you can have. Next, they've got $1.2 million in Australian shares. And the reason why they've got that is that if this was to earn a 5% income yield, then it would generate $60,000 a year of returns. And each client can actually have $30,000 a year tax-free when you consider the seniors and pensioners tax offset. Plus, Australian shares also allow for franked dividends refunds, which gives them extra money that the companies have already paid in corporate tax at 30%. Next, the clients could have $500,000 in superannuation in an accumulation account, and this would be taxed at 15% on the earnings. And that's essentially the overflow amount for their total $7.5 million wealth. Now, the reason why this is a really good structure is when we look at the amount of income that it's producing, $5.5 million of the assets are income producing assets, and only $2 million of the home is not. So they can generate a really considerable amount of income. Next, when we look at the tax implications, we know that there's no tax in these pension accounts and unlikely to be in the share portfolio as well. In fact, probably a refund. And then in superannuation, it's just a nominal 15% tax on the earnings of that $500,000 portfolio. So it's really good from a tax perspective. It's also really low cost. And I'll compare that against the scenarios where there's more property involved to show you some of the differences as well there. So that's the tax and income implications now. But if we fast forward to inheritance and assuming this couple give their adult children the wealth that's left over at the end, then let's look at the tax and cost implications at that point. So family home, $2 million, if that's sold within the first 2 years, then typically it's capital gains tax-free for the children beneficiaries.